This is a how-to episode on how alimony or Colorado maintenance payments work in a Colorado divorce. Now, the first thing we need to understand that there's the difference between temporary and permanent maintenance. If you don't know that difference or haven't listened to the how-to episode on that particular topic, I encourage you to check that out. And the reason that's important is because how alimony payments are made depends on if we're talking about temporary versus permanent maintenance oftentimes. And here's why. In temporary maintenance, if our hypothetical divorce clients, Eric and Melanie Wolf, if Melanie is ordered to pay Eric a particular amount in temporary maintenance, let's say it's $5,000 a month, oftentimes in a temporary maintenance situation, one party is going to be living in the house, or there's going to be various expenses such as the cell phone, insurance, mortgage, car payments, those sorts of things that we haven't yet unwound or really divided between Eric and Melanie. Melanie might be ordered to pay $5,000 a month, but of that amount, she is going to pay the mortgage that is for the marital residence that Eric is living in. Then that would be taken into consideration. So if the mortgage is, let's say, $2,000 a month, then Melanie would pay the mortgage $2,000 directly to the bank, and then that would be offset or reduced from the $5,000 amount. But of that $3,000 that she owes Eric, she would be either sending that as a bank transfer or a check, and she would be doing that usually on a monthly basis. Now, we can split up and have it be done where she, for example, pays Eric $1,500, so half of her amount on the first of the month, and then another $1,500 on the 15th of the month. And that might be based on her pay schedule or something of that variety. Now, we also have in permanent maintenance, you have that same dynamic, but it becomes far less common in terms of the payments being made directly to a bank. And usually or the mortgage, I should say, usually what we'll have is Melanie will pay Eric, let's say that $5,000, and she'll make that payment. And again, it's preferable to have some sort of, in today's kind of digital banking world, some sort of wire transfer or ACH or some sort of transfer between Eric and Melanie's account, and she'll set that up automatically. And that would be being made directly into Eric's bank account. And then he, in turn, would be responsible after the divorce for his own insurance, his cell phone bill, medical expenses, the mortgage, all of those things. Now, that would depend in part on whether or not they continue to co-own or have a mortgage in both of their names. That's becoming more common right now because of the elevated interest rates, and more people are deciding to have some sort of grace period of a year or 2 or 3 even years on that mortgage. And so Melanie's going to make sure that the mortgage is paid, so her credit, if she's attached to that mortgage, is taken care of. But that is how maintenance payments work, and it should be obvious, but to make the point, Eric's going to be responsible for his own expenses out of that $5,000 and whatever income he has of his own after the divorce. So he's going to be paying for the credit cards and all of those things. Often what we do not have is an offset, or there's some thing, and that's usually comes into child support, which I'll get into. And that the example would be that Eric pays for something that Melanie needs to reimburse him by, or vice versa, and Melanie in turn would reduce the amount that she pays. But that is more, as I said, more relevant or happens more often in child support, which I'll record as separate how-to episode. But for now, that's how alimony or spousal maintenance payments work in a Colorado divorce. And until next time, thanks for joining us on the Divorce at Altitude podcast.